Those two charts, they tell a very simple story about investing, and as is often the case here in Double Nickel, it's a story about time. Let me briefly explain what those charts are illustrating. I started out thinking about when does someone usually begin to invest? And they either go to college or they go to trade school, maybe they have to do an apprenticeship after high school, and then they go to work, maybe at 22. So we use 22 years of age as the starting point for the first one. And we illustrated a $200 a month investment into the S&P 500 using the rough historical average return of 10% annually over 33 years, leading up to age 55, to Double Nickel, where I'm at, and what that would turn into. And if you have $200 a month invested at that return, you end up with over $500,000, $587,000 after 33 years. And then I illustrated what it would be like for someone who chooses to wait. They want to live it up in their 20s, and they want to wait till age 32 and start investing, leaving them 23 years to invest before they get to Double Nickel. And because of that, they want to invest more. They want to invest $400 a month. Same rate of return, but the problem is you only end up with $381,000 into that period. Twice as much money invested every month and still behind. What's the lesson here? Well, the lesson is it's extremely difficult to catch up to your past self. Now, I want to state right now that I'm not a financial advisor. What I'm sharing today is just wisdom. It is information that I've learned through my own experiences over the years. So, depending on where you are in life and what you're going through, your lesson from that chart is going to be a little bit different. So, to those of you who are younger and watching this, I want to encourage you by letting you know that the biggest advantage that you have is not your income. It's not even the size of the investment that you make. It's truly time. I would encourage you to invest early and consistently. Stick with it. Don't be discouraged when that balance grows slowly. What you'll see over time is there's this bend where it's called the hockey stick. The compounding really begins to accelerate in later years. That's why there's such a difference in those two charts. Also, small amounts matter. Dollar invested at age 22, by the time you retire, compounds so many times. It becomes so much larger than a dollar invested later. And that's the other part of it. Compounding needs time to work. So the sooner you get money invested, the sooner you put money to work for you, the more valuable it'll be to you later. So I would tell my younger viewers, if your company offers a 401k, utilize that thing. If it has a match, if there's a company match, by all means, make sure you capture that. It's essential to grab that free money. It makes reaching the goal of maybe $200 a month, like I used in this illustration, so much more achievable if the company's got skin in the game with you. So the point here for those of you who are younger, you don't have to be perfect. This isn't about making great investment selections, buying individual stocks or anything like that. You don't have to be Warren Buffett. Just invest and stay with it. Time makes a huge difference. It makes a bigger difference than any of the other components of your investment life. Then there are my peer group that needs to think about this. Those of us who are approaching retirement. And we've learned a lot of the lessons about compounding if we've been at it very long. We've looked back and saw how those dollars that we put to work years ago, decades ago, have grown. And now we're trying to figure out, how do we take this investment portfolio, how do we take this money that we've set aside, this asset, and use it to support our life? And for me, I landed on something called the bucket strategy. I didn't invent it. It's a popular concept. And I'll tell you, though, how I've applied it and how it's made the transition more comfortable for me. So there's like three buckets that I think about. There is the cash/money market bucket of money that I have set aside. It's roughly a year worth of expenses, whatever that is for you. And it has the purpose of being available for immediate spend. It's very stable. It's not dependent on the market. It's a barrier to what they call sequence of returns risk. You don't want to have all your money in the market. You walk into retirement and lo and behold, the first week of your retirement, the stock market has one of those large corrective events, and now the money that you're wanting to spend is decreased because you had it in stock and the stock market went down. So you have that first bucket, your cash bucket, your liquid bucket, and maybe a year's worth of spending that buffers you from negative market experiences. Then I got a second bucket that you need to think about. These are your 3 to 5 years worth of dollars. A good place for this is something like CDs, maybe bond funds, an aggregate bond index fund, something like that. You don't have to get super creative here. But the point of it is to be a buffer. It's a buffer against those market downturns that I just talked about. It will also move. Interest rates affect bonds. CDs don't. If you hold them to maturity, they're stable. So that's a great alternative to bond funds, or maybe some mix of both. But it's your midterm investment assets. It prevents us from having to sell those stocks like I talked about in a bad market. And then bucket 3 is your growth part of your portfolio. It's everything else. You've got your 1 year worth of expenses and some kind of liquid alternative, cash, a money market, a checking account, a savings account. Then you have your conservative investments in CDs or bonds, something that's a buffer, but still growing through interest and compounding in that way. And then the rest is your growth portfolio. It's designed for long-term growth. It's going to be more volatile. It's going to go up and down. And that's why you have those other 2 buckets. You have that first year bucket of cash. You have that mid-tier bucket of more conservative investments, but still realizing some growth. Those are assets that you can tap early in retirement while your growth portfolio is compounding and growing. This bucket approach has really helped me as I prepare to transition from my career, from my working life into retirement. So that's how I suggest you set things up if that sounds like something that worked for you. Then there are those of you watching who have already retired. You've made the transition already. You've hit double nickel or some later date, and you've decided it was time to quit. And I hear a challenge mentioned over and over again, and I can understand it. We reach a point where we've been lifelong savers, and now we have to transition from saving to decumulation, to spending. And it's a struggle sometimes for those of us who have been savers to give ourselves permission to spend, to use that asset that's been created over time. You spend 30 or 40 years working on this and accumulating, and suddenly you're supposed to start spending it. That's a difficult thing. I can understand it. But it's important that you do that, and here's why. There are about 3 phases to retirement, so I'm told. And I'm anticipating this to be true. I've actually observed it in people's lives, in my family and in friends. First of all, you've got what they call the go-go years. This is a period when you're healthy, you're active, you're able to travel, have these experiences, and do the things you want to do more easily because you're physically able to do so and emotionally able to handle it. This is when you still have health and energy. And it's the concept behind double nickel for me, wanting to capitalize on those early years of retirement, those best years available to us. We have assets and we have time, and we go make the most of that in life. So that's what double nickel is about. Those are go-go years. You need to give yourself some permission, some license to use those assets that you've built over years. As you get a little older and you begin to develop more aches and pains and slow down a little bit, they're called the slow-go years. You're still active, but you're slowing down. You're not as active as you used to be. Travel becomes something that happens at an easier pace, maybe not as long of trips. They're less frequent. You slow down from where you were in that early part of retirement. And then you enter those no-go years where you have limited mobility. You spend more time at home. You've got more medical concerns to deal with. I've observed people go through all of this where they enter retirement and they have a lot of energy. They're vigorous and they're ready to go. And then as they progress into retirement, you can see things begin to chip away at their ability to do what they want to do. And then, like I shared with you about my mom, she entered those no-go years where she was no longer able to experience the things that she wanted to do and travel as much. So if you've prepared well, you need to give yourself permission. If you've taken responsibility for your retirement and you've saved and invested and you've now transitioned into retirement, you need to enjoy those early retirement years while you have the health and energy to do so. Don't defer the spending in retirement. Fear kind of drives us that way. We want to hang on to that balance. That's why I like the bucket strategy so much. You have some dedicated dollars that you specifically set aside to use that first year. And so you go do that. You don't have to ask yourself, is this a good time? How's the market behaving? Should I do it or not? You set those dollars aside. And then that middle time where you're 3 to 5 years out from your career, you've got some conservative investments that still have grown some. They're producing some income. You begin to start making some decisions in your slow go years after you've maybe transitioned out of go-go phase. And meanwhile, your portfolio that's in that third bucket is continuing to grow and support your lifestyle, so you can check and adjust as you move along in retirement. The thing about the chart that's really more important than investing is that it's about time, bringing it back to that. The earlier you start investing in life, the greater your investment returns are going to be, and your ability to support the life you want when you finally do retire. As I think about this, I would be so interested to see what it is that you have to say about your investing journey, wherever you're at, whether you're just starting out, or you're like me, you're approaching retirement, or you're already there and you're trying to work your way through these phases of go, slow go, no go. Maybe you don't even experience it that way, and it's not how it really is. Maybe you're struggling with giving yourself permission to spend, and you want to talk about that. Put it in the comments. I'd love to hear from you. I'll respond and engage with you if you have something to share. You can work harder later, but you can't recreate time. That's the lesson here. You have to start early. So start early if you can, and start today if you haven't. Until next time, let's see where double nickel takes us.